On the 12th of June 2026, SpaceX debuted on the Nasdaq. The stock opened at $150 and closed up 19% in its first 6 hours. At a $2.1 trillion valuation, the company became larger than every American defense contractor combined. That afternoon, Elon Musk officially became the first trillionaire in human history. Deep within the 174-page IPO prospectus, however, lies a specific timing mechanism. It is scheduled to trigger in late August. This mechanism directly impacts the millions of Americans holding 401 KES, IRAs, and 529 plans. These retirement accounts are often automatically tied to the stock's performance, usually without the account holders being notified of the structural risks involved. While the public narrative focused on the scale of the launch, the fine print detailed a structural wealth transfer. The IPO's design uses new retirement capital to provide the necessary liquidity for original insiders to exit their positions. This process begins by manufacturing artificial demand. Shortly before the IPO, Nasdaq quietly updated its rules regarding how new stocks enter its primary index. For decades, companies had to wait 3 months before joining the Nasdaq 100. This buffer gave the market time to establish a fair price before billions in passive index money was required to buy in. The new rule reduced that 3-month wait to just 15 trading days. By early July, over $650 billion in passive funds are legally mandated to buy SpaceX shares, regardless of the price. To amplify this effect, Nasdaq utilized a free float multiplier. This treats SpaceX's small share supply as if it were 3 times larger, forcing index funds to buy in greater volumes. Because this mandated buying vastly exceeds actual supply, the stock price is pushed higher. This results in retirement accounts purchasing the stock at an artificially inflated peak, through a process the account holders never personally initiated. As the buyers are being pushed in, a second timer prepares the sellers. Standard IPOs use a 6-month lockup period to prevent early insiders from flooding the market with shares and crashing the price. SpaceX departed from this industry standard by drafting a custom lockup schedule. This schedule allows employees and early backers to sell 20% of their holdings just weeks after the first public earnings report in late August. Many of these insiders acquired their shares for pennies over the last decade. At a $161 trading price, the incentive to lock in those returns is massive. The IPO structure is sequenced to ensure the buyers enter first. Once the price has been buoyed by passive index demand, the doors open for insiders to liquidate their holdings. When those insiders begin selling millions of shares in late August, the market requires a massive amount of capital to maintain the price. Institutional investors often avoid buying at these levels. The Morningstar model recently valued SpaceX at $780 billion, a figure dwarfed by the $2.1 trillion market price. The $1.3 trillion gap between the trading price and the fair value model is significant. For scale, that discrepancy alone exceeds the entire annual GDP of Canada. Since passive funds have already completed their mandated buying in July, they cannot absorb the new supply. This leaves retail investors as the primary source of liquidity. When insider supply meets a lack of institutional demand, the price typically adjusts downward, leaving the retail buyers to carry the valuation loss. This sequence follows a documented pattern seen across several high-profile listings over the last 10 years. Facebook's 2012 IPO followed this path. Once its lockup periods began to expire, the stock price fell 54% in 4 months. Uber saw a similar result in 2019. The stock dropped 44% shortly after its insiders were cleared to sell. Snap, Lyft, and Alibaba all utilized this same structural playbook: manufactured upfront demand, followed by a delayed release of insider shares. The SpaceX IPO uses optimized index rules and custom lockup schedules to prioritize the exit of its earliest backers. The mechanics of the listing are engineered to turn new retail demand into the final exit strategy for those who bought in years ago.